What's up everyone, it's Scotty with MoneyVest. So in today's video, we're going to be talking about Tesla stock, which got a nasty downgrade on the day with a 38% price decrease from $200 per share down to $135 per share from an analyst at Wells Fargo. So I'm going to break that report down. There's good news and there's bad news. Bad news, of course, being the price downgrade and a significant slashing in the price target. And the good news is from Dan Ives, from Wedbush Securities, kind of reiterating his bull thesis on a Tesla for the long term. The stock here absolutely getting crushed here. I think 150s is possible for Tesla in the future, in the near future. That is something that we need to be prepared for mentally, and we could see that target for Tesla here. I'm going to break down everything you need to know. As always, make sure that you drop a like and don't forget to subscribe to the channel. Links to our Discord and Patreon is going to be down below if you're interested in joining us, and of course getting access to all the members only private videos, including all the trade alerts and trade ideas, options alerts, as well as all the trading view charts and watch lists, and our moneyvest.com platform that's going to be launching very soon. So links going to be down below. And this right here, of course, is the sell Tesla stock. Analyst slashes target 38%, saying EV maker isn't so magnificent anymore. So this, again, comes from Wells Fargo analyst Colin Langan, is the bearish analyst here. On Wednesday, he downgraded Tesla stock to the equivalent of sell from hold, and his price target went down to $125 per share, down from 200. That's almost a 38% decline in the actual price target. And he says, and I quote, "Tesla ain't looking so magnificent, and we expect volume to disappoint as price cuts are having a diminishing impact on demand. Lower deliveries and vehicle price drive our 2024 earnings per share estimate 32% below consensus." So this right here is quite literally the definition of what I've explained before, and how institutional investors and Wall Street analysts, all they care about is profitability. At the bottom line, earnings and profitability, and rightly so, because that's, at the end of the day, every business is looking for profit, looking to maximize profit, and looking to generate net income and earnings. And that's what makes the business very, very viable. That's what makes the business more sustainable long term. And even on this channel, when we're looking for high quality companies, we're looking for companies that have, very strong numbers, very strong cash flows and earnings and whatnot. We prioritize, earnings and bottom line profit, right? That's a very, very important metric for us that we look for, because that tells us, okay, it's a proven business model. It's a proven company that's on the track to generating more earnings and more profit. And that's what makes the company sustainable and viable over the long term. So that's understandable. But at the same time, as I've mentioned before, that Wall Street analysts have a very, very short time horizon. They're looking for at least 1 year out, maybe a couple years out, but beyond that, they don't forecast for that far out. So they don't see how Tesla today may have headwinds in the short term, but has significant tailwinds over the long term as things start to normalize. So his numbers are jarring. Langan now projects 1.8 million deliveries in 2024, basically flat compared to 2023, and he doesn't project any volume growth in 2025 compared to 2024 either. So basically, he's expecting Tesla to deliver flat deliveries in vehicles here over the next couple of years. And as for sales, his 2024 and 2025 sales estimates are now at 91 billion and 96 billion respectively, down from a prior projection of 102, 118 billion. That's a significant cut down on the revenue numbers. And Wall Street consensus of 110 and 131 billion dollars. That's like about almost $40 billion less is what they're expecting the company is going to make. And Tesla generated about $97 billion in sales in 2023. So they're expecting about a decline in both the revenue. And now coming down to the bottom line earnings, they expect 2024 EPS of about $2 per share. That's down from $2.40. And the consensus call aggregated by FactSet is just over $3. It's a 50% decline in EPS expectations, and Tesla generated $3.12 in 2023, and his new 2025 EPS estimate is $1.90. That's going to be even lower from 2024, and of course significantly lower down from 2023 as well. The Wall Street consensus was $4.16. So as Wall Street is going higher, basically the consensus is still to accelerate earnings from about $3 to $4. That's a 50% increase year over year from 2024 to 2025. This analyst is cutting down on the EPS and the revenue expectations from $2 to $1.90. And, kind of looking at the price cuts, looking at the margin compression, I don't blame him in his analysis and his thinking of the earnings coming down and the revenue coming down and delivery staying flat, because Tesla has kind of operated in that manner in the last 6 months, in the last, I would say, even 4 quarters, where Tesla's continued to kind of cut prices in 2022. and 2023, and we've continued to see margins compress here for the company, and as a result, that's now starting to hurt the bottom line, which I've also mentioned kind of briefly in one of my other videos, that there is some concern, there is definitely some expectations from analysts that Tesla could actually become a loss-making company in 2024. And if that actually happens, that is really going to crush the stock here in the short term. And that's something that mentally we need to be ready for, because it is really going to be a very, very challenging time for Tesla if margins come down to near break-evens or even sub 0%, because that is a clear sign that Tesla has no pricing power. Like, Tesla has no pricing power whatsoever, and they're having to reduce these prices in order to spur demand, and they're doing that at the expense of their profitability. I've said this before. I actually did multiple videos back in 2023 talking about this very idea, that Tesla cutting prices is not because they can, is because they need to. There's a huge difference, right? And again, it's kind of like, if they had pricing power, if they had efficiency, if they had a very, very significant amount of operating leverage, they would have been able to cut prices while maintaining those margins, right? But right now what's happening is the cost of producing an electric vehicle with Tesla is coming down, but the prices at which they're selling them are coming down faster. So the rate of these price cuts is significantly faster than the rate of decrease in the cost of production. And that's why margins are getting squeezed. If the margins were stable and maintained where they are, that means both the cost of producing a vehicle and the price cuts are happening at the same rate. But that's not happening right now. I mean, it's just price cuts are happening more aggressively than the cost of producing a vehicle, and as a result, margins are getting squeezed. We just are expecting and really hoping. Hope is not a strategy, and know that, but we don't know what Tesla is going to do with respect to price cuts and future margins here and how they're going to play out. But the expectation really should be that, okay, Tesla is more or less done with these price cuts, and they've got to draw that line in the sand that, okay, no more price cuts are going to happen, because what's really happening right now, and as something that I've already mentioned before, is that if they continue to do these price cuts, people are going to get so accustomed to this that every month or every few weeks, Tesla is going to come out with some new price cuts or new subsidies and new discounts, that they're going to stop buying vehicles. They're going to be like, okay, let's just wait. Let's just wait to see how low the prices can really go, and then we'll put in an order. Then we'll really buy, because that's what happens in a deflation environment. Because when prices keep coming down, people hold off on buying because they start to believe, they start to expect prices to go lower and lower and lower. And what happens is the demand starts to go away, right? Because if people are expecting prices to be lower 1 month later, what are you going to do? You're going to hold off. You're going to be patient. You're going to, let the prices come down even further. And that is demand kind of leaving the market, and thereby Tesla kind of sensing that, and then they have to lower prices even more. So it's kind of like this spiral, which they have to draw a line in the sand and be like, okay, no more price cuts. We are done. This is the final price, and this is what you have to pay. And again, until Elon Musk and Tesla kind of actually do that, there is going to be concerns. There is going to be some problems and some challenges here. But now switching over to the bullish side, Wedbush analyst Dan Ives doesn't feel nearly as bearish. He says the Tesla narrative is as negative as we have seen in the last few years, with Musk and Tesla getting attacked by the bears from all directions. And the demand story for Tesla is more in stabilization mode heading to the rest of 2024. Price cuts are moderating. Battery cost production is showing strong cost efficiencies, and a Model 2 is on the roadmap for next year. He rates the shares as buy with a $315 price target. Overall, 36% of analysts covering the stock rate as a buy, 36% only. So only a third of analysts are putting a stock as a buy, and the average buy rating ratio for shares in S&P is about 55%. So that is 36%, obviously a lot lower than the average S&P 500 buy rating ratio. And a downgrade to sell from hold doesn't change the buy rating ratio. Overall, 18% of analysts covering the stock rate the shares as sell, and the average sell rating ratio in the S&P is about 7%. So Tesla definitely has lower buy ratings compared to the S&P 500 and higher sell ratings compared to the S&P 500. The momentum is really, really weak on the short side, and unfortunately, we are hitting a new low since May of 2023. And as unfortunate as it is, I wouldn't be surprised if Tesla gets down to 150s here in the near future. So, those right there are going to be some levels to keep in mind. That is pretty much my next support level to watch for Tesla in the 150s, and of course, a more brutal support all the way down from January 23 lows at around $103 per share for Tesla as well. So those right there are going to be some levels to watch. Momentum very, very weak, very much against the bulls here, and again, consistently making lower highs and lower lows. So it's very common for us to see more momentum to the downside for Tesla, down about 3.5% on the day. So let me know your thoughts down in the comment section below. It really just all comes down to how much pricing power Tesla has, what kind of operating leverage are we working with, how many price cuts are we going to see, and that's really creating this dynamic where users and consumers in general are holding off on their purchase of Teslas because they believe that, okay, there may be more price cuts coming down the pipeline because the resale value of Teslas is not that great. I mean, it's just not. There's so many people that are upside down on the loans for Tesla that they finance vehicles for 5 years or 10 years. They're paying whatever 3-4% on those auto loans. They bought them for 70, 80, 90,000 US dollars, and now the vehicles are half the price of what they paid for them, but they still owe that much on their auto loans for these vehicles, where you can buy a brand new one for half the cost or even lower. So, that's a very, very painful dynamic for Tesla vehicles here. But we just got to keep a close eye on where it ends up. My fair value, as you already know, is sitting in the 150. So that is a level to keep in mind for Tesla in about $150. And that really prices us at around about, I would say, like 30 to 35 times earnings multiple on an electric vehicle basis. But that's the thing. EV, earnings expectations are subject to change. And as we've already seen, if this analyst is looking at $2 in earnings per share for Tesla at 170, I mean, we're working with closer to 75, actually 85 times earnings multiple based on a $2 EPS. That is a very, very high of a valuation for Tesla. So a lot of it depends on where the earnings expectations go for Tesla over the next couple of years. So let me know your thoughts down in the comment section below. Hope you all enjoyed it, found it helpful. Make sure that you drop a like and subscribe to the channel. Links to our Discord and Patreon is going to be down below. There is a 16% annual discount that's available until the end of this month. And as always, happy investing. I'll see you all in the next video.